Your 2019 year-end target is 3,200, so you're looking for basically 100 S&Ps between now and the end of the year.
Yes.
You can get there? Confident?
Yeah. I mean, I think we could even exceed it in the next 7 weeks.
Because of?
Well, I think the cadence of economic data is really improving. I think as people start thinking about next year, they're going to see upside risk to growth. And then when you look at positioning, I think people are still uncomfortably defensively positioned. So that movement of cash into equities is part of that rocket fuel.
Okay. Belski, so on October 30th, I want to read something that you wrote, because it sort of caught my eye. You're a generally bullish guy on the market. This didn't sound all that bullish, though.
Hit me.
As we have mentioned frequently, we do not expect significant gains from current levels for the remainder of the year, with the main reason being the unpredictability associated with geopolitical headwinds and developments, particularly trade, which has been the predominant topic of our client conversations lately. Talk to me. You were getting a little cautious at the end of October?
Well, first off, when we initiated our target for 2019, we were at 3,150, and then obviously we had the terrible fourth quarter last year, and then the even worse December. So we thought it was apropos and prudent to move it to 3,000.
And you never moved it off that?
Never moved it off that. Why would you move a target for 6 weeks left in the year? That doesn't make any sense to us, number one. Number two, when we invest, Scott, we look out 12 to 18 months.
That's no, but you had chances all along the way to move it up.
Yeah,
right?
Of course we did. But at the end of the day, too, we still think that we don't have an absolute perfect trade deal. We think that the Santa Claus rally actually moved forward into October this time around, basically given the fact that people became way too bearish in August and positionally were way too short-term sighted. And sure, yeah, if you want to nitpick and change a target by a few percentage points, but at the end of the day, we still think we're in a big 20-year bull market, which has been our call since 2010. And we think stocks move higher. We're entering into this mid-90s type of Goldilocks scenario where earnings stability and high quality really matter. And that's why large-cap U.S. companies, we think, are the best positions in the world.
What I wanted to tee up by getting your perspectives between now and the end of the year, which is somewhat, unimportant looking at the big picture, are the calls like that you make. Tom Lee, well, this may sound perplexing. We believe 2019 was the start of a new global equity bull market. Belski just laid his out, too. Welcome to the second half of the bull market, implying your 20-year thing. We've been on a 10-year run. I want to open that to the panel. Is that what this is? Is this mid-cycle of bull market? Are we looking for a much more prolonged cycle, Josh, than we've thought?
So, first of all, let me unveil my year-end. My year-end target is December 31st. So I think I'm gonna nail that one. I'm not good with targets and timing bull markets. I don't really think that my opinion is any better than anyone else's. But what I will say, where I agree with both of the views that we heard, I really don't understand why we're still talking about 10-year runs. We had a bear market low in March of 2009. That was the bottom of a secular bear market that lasted from the year 2000 until 2013. You had a 13-year secular bear. When we talk about bear markets, bull markets, historical bull markets, 1982 to 2000 is the greatest bull market ever. We talk about it all the time. We don't time that from 1974, which was the low of the secular bear market that preceded it. So the 2009 comp, the 11-year, the 10-year, whatever, it's incorrect. We made a new S&P record high in the spring of 2013. It is the first time we got definitively above the 2000 high and the 2007 high from the prior peak. That's it. So basically, it's a 6-year run. And in the midst of that 6-year run, we had a down year. It was last year. So we have had bear markets, cyclical bear markets already within that long-term bull. It is not as though we've been rallying for 11 years nonstop. And by the way, the global component of it is the most interesting to me. And I don't know if it'll be right, but I hope it is. We may have had a really nice run in U.S. stocks. International stocks have essentially lagged, have done almost nothing. Emerging markets have been disastrous. If that part of the equation began to get fixed this year, and it is possible, that could extend the run because you're talking about middle-class populations in the billions coming on in the next 10 years that have not really taken part in fueling earnings growth. And if they do, if you start seeing a pickup in consumer demand in Asia, in Latin America, in Europe, That's a whole new leg, not just for international stocks, but for S&P 500 companies that cater to them. So I really think that there is an opportunity for this to go on way longer than people think, given that it started much more recently than people think.